e-commerce has made life significantly easier for most of us, especially during COVID, where online purchasing jumped almost 40%. And according to some estimates, e-commerce in Asia is expected to reach $1.8 billion this year. Even though shopping online has been around a long time, behind the convenience to the consumer, there are a lot of challenges. One of those big ones is payments. And within payments, there is an inordinate number of challenges that are constantly evolving, from security to fraud, transaction processing, and payments insurance. This whole area represents a massive opportunity for founders. So joining us today, founded by veterans Rajiv Chandna and Tom Duncan, is one of those startups. And they're tackling a relatively arcane and unknown area of this problem. Kinetic technology, based out of Singapore, still pre-A, but already gaining traction with the top payment providers in the region. I'm joined by Rajiv. Where are you hailing from?
Dialing in from Singapore today, Jonathan.
Back in Singapore, I hear you've been traveling.
Yeah, I was out to meet some of our clients in the UK for the last couple of weeks, but yeah, back in Singapore now.
So I've heard a lot, you're pre-A and you've already got a lot of traction. I know your chief technology officer, Nadeem, quite well. And it took some time for me to kind of understand, exactly how the technology translates to the problem. So why don't you help me unpack, the solution that you've come up with, and let's start by looking at, what is the problem?
Yeah, no, thanks, Jonathan. Thanks for giving me the opportunity. So I suppose my big aha moment was, and before, co-founding Kinetic, I ran a payments company. And I remember this one particular day where we were bringing on this education company based in Thailand, French lessons for kids. You pay upfront $400. Your poor kids attend those French lessons for the next sort of 3 months. And to me, sounds like a great business. We'd make a decent bit of margin. And as I was onboarding them, my risk team said, no way. Because this merchant is taking a bunch of money up front from customers. We don't know if that merchant is going to be around in the next 3 months. What if that merchant doesn't deliver the product, i.e. the French lessons that they're promising to the customers? And the payments value chain is set up such that if the merchant doesn't fulfill their promise, that liability shifts to the payments company that contracted the merchant. And payments company, and rightly so, my risk officer, were concerned that we need to protect ourselves against that merchant going bust. And we were going to take 15% of their annual sales, put that into an escrow account on a perpetual basis. And we're talking about a small Thai business here, because we are afraid that that merchant may go bust at some point in the future. And as I started to dig this area up, you see this everywhere. It's education, it's ticketing, it's venue hires, it's of course airlines, hotels. It's basically wherever you're not having a cup of coffee and you're paying, you're drinking, you're out of there. Everything else brings this risk to the payments company. And in the post-COVID world, where you're ordering your shirts online and made to order suits online, this problem is getting bigger and bigger. $300 billion sitting in escrow accounts around the world doing nothing. Money that should be sitting in the merchant's pocket so that they should be growing their business fast. Issues that payments companies should not need to solve for in such an arcane way by taking effectively working capital from these small businesses just so that they are protected at some future loss.
That's a massive amount, right? That's a massive amount for a small business. So I guess in the old days, if you went down to your local retail outlet, local cafe, would they have to hold the same amount of collateral, given that the goods are like given to the customer immediately. Was the problem the same back in those days?
So it's accentuated in the e-commerce world, but certainly even back in the days, if you had a tour package company offering, a tour package that you take in 6 months' time, that tour package company was giving up some of their working capital to the payments company. Now that comes in various ways. It could be a personal guarantee from a director, but everything is a cost basically to that merchant just to be able to accept payments from the payments company. They're giving up some version of their working capital that they should be deploying back in their business.
That's yeah. I guess it's one of those things we never think about. The convenience of the card. There is an inconvenience being hidden behind the scenes, right? And that's like almost a month of working capital for the merchant.
And the worst part is, you've held this collateral with the payments company. Now the payments company, this is the only tool they have. Now think about a scenario where the payments company gets slightly worried that, look, this furniture merchant that's taking a bunch of money up front for, future dated orders for beds and couches and whatnot. They think that this merchant's going under or under some kind of financial distress. How do they protect themselves? They take more collateral. Instead of 10%, it becomes 15%. Instead of 15%, it becomes 20%. And effectively, that's where the, merchant starts to go into even more financial distress. And, I'm not going to name any names, but you can go onto any of these forums and you can search, why did collateral kill my business? And you'll see all these merchants basically complaining that they've got money stuck with the payments company. They should be using that money to pay their employees, pay their suppliers, delivering goods to their customers, but they can't access that money because the payments company, and rightly so, want to protect themselves. I mean, Hong Kong, where you are right now, Jonathan, one gym chain went bust. And without naming names, one large payment company took a $5 million loss because that gym chain went bust. There's a large airline in India that went bust, left $60 million in losses to the payments company. So the payment companies are not wrongly worried. They are worried. It's just that they've got the single blunt tool in their arsenal to protect themselves.
Okay, so that's a great segue. The problem that you're tackling is a big one. It's also one that doesn't get a lot of attention. What have you kind of faced any friction trying to, solve this problem?
Yeah, I mean, fundamentally, we'll talk about the sort of the way we've solved this problem. We've basically created a capability to answer the question, is this merchant good? Is this merchant bad? So start with a very binary answer. There are clearly some bad merchants out there who are doing fraud, who have no intention to deliver the product or the service. We have a capability to screen those merchants out right at the start. That's a very, very, very small percentage. For the rest of the merchants, we're able to risk score them and, give a score to the payments company very quickly, right at the point of onboarding. And we're able to give them a range of solutions that they can protect themselves with. They can do things like, let's start off small with that merchant. They can go work with an insurance company to insure that kind of risk of that merchant going bust. They can sell slightly deferred delivery. So they can do a T+2 delivery or T+3 delivery after that. So we come up with a range of answers for payments company to help protect themselves. The biggest innovation that we've done is being able to price the risk of the merchant very, very accurately and be able to offboard that risk where necessary onto large insurance companies so that the payments company remain protected. They can go to these furniture merchants, these tour package companies, and help them run their transactions in a friction-free way.
I have to ask, are you using AI? Do you want to say AI or generative AI?
Look, we started off by having multiple sources of data. I guess, before the big chat GPT moment, we were using multiple sources of data to come up with intelligent answers for our payment companies. That went into a knowledge graph. It used machine learning technology. But sure, we're going to call it AI from now on for sure.
So this is almost a math problem, isn't it? Like that you're solving here.
I mean, it's definitely a very, very data-driven solution. It does take multiple sources of data to be able to price the risk accurately and build an underwriting model that, for example, a AAA rated $1 trillion balance sheet insurance company would be happy with. So it definitely is data driven. But there is a lot of creativity that comes into it. I'll give you an example. If today you're a payment company and you want to onboard a hotel, which is doing delayed delivery, classic delayed delivery, you book a room booking, you basically apply the same logic to both of them. But if you work with us, we help you differentiate between a Hong Kong city center hotel, quite different to a ski chalet in France.
Oh, interesting.
Because a Hong Kong city center hotel is maximum of 1 day booking, 1 week in advance booking, or maybe 2 week in advance booking. Very different risk versus a ski chalet that you book maybe 6, even 9 months in advance because you want to go on a holiday to Europe with your family. Very different risk, very different classification of risk, very different types of protection that you need. So there is creativity, there is nuance, and I'll say it. We do use a lot of artificial intelligence to help us think about what are the predictive delayed delivery, how risky does that delayed delivery mean? A 9 months in advance booking is fundamentally more riskier than a Hong Kong city center hotel. Even though if you were to do a pure sort of data-driven approach, you'll just put them both under a hotel category and in theory have the same level of protection against them, which doesn't make any sense.
Yeah, because essentially what you're talking about there is the customer is different, the customer intention is different, and then the merchant's intention and probably the merchants themselves are different from the perspective of who they are and what their business models are. So it's an interesting way of looking at it that normally you wouldn't really think about, right?
Yeah, or like take football clubs in the UK, something that we've been supporting payment companies manage. If you are if you're buying tickets for a football game, you'll have two types of tickets. You'll have season tickets, very different risk, paying a bunch of money up front for the next 10 months of matches versus you're buying a ticket for a match next week. How do we help you disaggregate that payment information to help you really think about what's your value at risk? Sure, you need to protect yourself against those season tickets because for whatever reason that tier 3 football club is not able to host some of those games. Sure, yes, you need to protect yourself and insurance is a fantastic answer for that. But you don't need to protect yourself for tickets for a match next week because it's near guaranteed that that'll get delivered. But that's not the approach a payment company is able to take today. And I think that's some of the capability that we are able to bring. And that's kind of where I think it is a math problem, but it's also an art problem.
So talk a little bit more about who your customers would be. So you've mentioned payment companies. Would it be merchants directly, or would it be always bundled as part of a merchant, a payment company's value proposition?
Yeah, to begin with, it's payment companies because I think the risk one is poorly understood. So we think that's clearly the right starting point for us. The next level up from there is marketplaces. So I'm not talking about the Amazons of the world. I'm talking about, aggregators that aggregate vet offerings or, other kind of hospital type offerings where again, lots of people are paying up front and you've got lots of merchants on that platform promising to deliver, say, medical devices at some point in the future. Now, how do I make sure that that underlying merchant is actually able to deliver? So it's a very classic old age problem that's surfacing up in the e-commerce digital era. Well, how do I trust the person who I haven't met, who I have no relationship with, where I'm going to be paying a bunch of money up front, that person will actually deliver what I need? How do I protect myself against that unknown risk of an unknown player?
And to be clear, it's not just credit card payments, right? It's that there are other types of payment companies you would look at.
Oh, 100%. 100%. As real-time payments is picking up around the world, regulators are equally worried about what's happening to those payments going through even account-to-account transactions from real-time transactions. I mean, I think the reality is, and maybe this is a tip for your listeners, is that in today's world, card transactions are the safest way of paying, because that's where, as a consumer, you've got the best defined rights to protect yourself against. I'm not saying account payment transactions aren't safe. It's just that to get your money back in a difficult scenario, it's not as black and white where your rights are. But in a card payment environment, those rights are black and white. But the regulatory environment is changing very quickly. We're working with a number of Indian companies now, with the Indian regulator, because non-card payments are bulk of the transactions in India, for example, are saying, I want the same level of protection for customers who are using non-card methods as for the card methods. So we're now seeing a whole range of companies that are reaching out to us talking about that problem. How do we safeguard our customers? How do we safeguard our merchants against probability of default?
So this to me sounds like common sense, right? So always with most reasonable startups, the idea, the product typically is not the problem. It's ultimately comes down to a distribution problem, which leads to the 90% failure rate of startups. What kind of challenges have you guys had trying to sell this idea? I mean, you're doing quite well now. Have there been any kind of major questions or hurdles you've come across along the way?
Man, I'm sure you must have heard this answer many times. I guess personally, I think there are two biggest hurdles that you face. One is a hurdle of self-doubt, where when the idea is just a piece of paper and, you're getting good feedback, you're getting sort of average feedback, you're getting negative feedback, and being able to wake up every day and convince yourself, convince your next hire, convince your team, convince your investors, your first partner that you could do this. And that takes overcoming your own self-doubt quite a bit before you have to get over the self-doubt or the doubt that you have from other parties. The second big challenge is the team. Building a team around an unknown solution is really hard. You want specialists, but you also want generalists. You want somebody who can, do the very, very micro work, but you also want somebody who has a big picture. And those are the initial days, and we're very much in the initial days. But I think we've got a really rock solid team now. You, of course, know our CTO, our chief risk officer. Big shout out to him. He's based in the UK. He's been a great addition to the team. Our head of product, he's been a great addition to the team. So we're very grateful for the team we've been able to build. And very grateful to our first partners who've come on board, supported us in getting this ship off the ground. And as they say, once you've got the first few partners in, the next one becomes a little bit easier. So I think we're starting to feel that. But yeah, as you said, early days, lots to solve.
Yeah. I mean, there is an element, founders have this strange dichotomy of like self-doubt and delusional confidence. It's I'm a founder as well. I'm not going to try to raise money against a professional services firm, which I think is a crazy thing to do. But you have moments of like am I going to pull this off? Set against, the overwhelming data that says you're not going to pull it off. But if you don't have people who are wired this way, we'd never solve any new problems. Like it's a very strange dichotomy. So I totally get it. And a lot of people I've spoken to, like you mentioned, are wired very, very similarly. So,
Yeah, I mean, certainly, and I mean, I guess the other reflection I have is that, but there is a certain magic to this process. That idea of that you've created something from nothing, and I'm not saying I have done that, but we as a team have created something from nothing. We've got a product that people are paying for. We've got a product that people look at it and think, oh, yeah, I never thought of solving it quite this way. That's pretty clever. And there is a certain magic to it. There is a certain, that slide to code journey, which is, yeah, I'm grateful I
rewarding.
got to. Yeah, it's very rewarding.
So, okay, what has been, obviously when these things come about, there's a problem. A lot of founders, if you remember, an app called Seismic. It was short video sharing, maybe 10, 15 years ago. It didn't stick because, the videos were bad, internet was slow, all of those things. And now we've got, TikTok that's, the biggest social media platform. What's the confluence of events? What's drawing the elements together that makes your solution right for today? Like, why are you guys here today?
Yeah, no, thanks for asking that question. And I certainly feel, despite where the macro environment is in terms of funding, we couldn't have timed it better. I mean, coming out of COVID, everyone's now digital. Effectively, everything is becoming delayed delivery, right? Like you're ordering your suits online, made to order suits online. So that whole e-commerce shift is huge, and therefore every payment company has now to think about: am I taking collateral or not, or how am I managing the risk of the match? So it's become a front and center problem. Second thing is that interest rates are super high, so that cost of collateral keeps going up. So that 300 billion left in an escrow account at a SME working capital loan is no less than 10% today, even in a sort of a benign environment, in a difficult environment, 10 to 15% interest rate on that stuck capital. So that cash is becoming much more precious. So merchants are pushing back against, look, we don't want to hold collateral with you anymore. You need to come up with something else. And the third is, ironically, during COVID, because of the huge amount of government stimulus, businesses actually didn't go bust. Actually, the level of bankruptcies went down during COVID. But now as the government stimulus is pulling back and there is no more sort of, small business support, actually the and the economic distress and, high cost of funds and so forth means that more and more businesses are going through financial distress. So payment companies are actually very, very worried, but they can't default to taking collateral because that collateral is precious. So we find ourselves coming into conversations with payment companies and insurance companies saying, look, there's a better way to do this. There's a market for this. And interestingly enough, payment companies and insurance companies aren't the best of bedfellows. Like there's there's been a huge amount of innovation in payments, lots of new players coming in and so on and so forth. But these large $1 trillion insurance balance sheets that need to think, what's the world going to be 50 years from today, aren't designed to react to it very, very quickly. So we find ourselves in a fortunate position where the market is pushing towards a different solution, and we are able to bring insurers on the table to protect payment companies against that risk.
So it's a very interesting place you guys find yourselves in, because in this kind of environment, capital is drying up everywhere because everyone wants to stick their money in bank accounts. You're kind of in this weird space where actually a tension exists that increases the demand for the product in this environment. But now you've got to find investors that understand the long play on that and give you guys liquidity, right? It's a very interesting problem I haven't heard from anyone else.
Yeah, and I think we've been very lucky with our investors so far. And like you said, we've had pretty good early traction. So hopefully, that process won't be too difficult going forward. But yeah, let's see how we get on.
Okay, so I have one last question for you, and this is the hardest question for every founder because it's so open. What's your vision or your view on this situation? And you can go as broad as like overall kind of payments or overall e-commerce and consumer behaviors. Or you can go very niche and look at, just your very specific area of payments. What do you think the future holds 2, 5, 10 years from now? I mean, 10 years is hard, but like what's the end state of this? What's the next evolution?
I mean, the big thing that I'd love to see is businesses being able to work with each other instantaneously in the most friction-free way possible. And these are businesses that don't need to know each other, don't need to have a relationship with each other, but don't need to go into very, very expensive risk mitigation routes before they get into business with each other. And I say this way beyond payments is because this stuck collateral, this stuck money is everywhere. So we're speaking to this one company in Indonesia that sells mobile top-ups. Today they host, in Hong Kong, maybe it's not that common, but in Indonesia, 90% of the Indonesians run on buying mobile credits as and when they run out. They buy these from third-party aggregators, but these third-party aggregators are leaving millions of dollars in collateral with telcos. Because telcos are like, well, you're selling something to your customer. We don't know if you're going to be around. So wherever we start to unpick, we see businesses aren't able to get into a trusting relationship with each other because they either don't understand the risk of the business they're working with or don't want to understand the risk of the business they're working with because it's just too much hassle. And we want to take all of that out of the equation. We want to create trust in the system. We want to create transparency in the system. We're obviously starting with payments because it's just a huge market. The rules are black and white. We can establish it. We can help people understand it. But really, the success of this business as we go along will be in helping businesses to work with each other in a friction-free way over and over again in domestic markets, in cross-border markets. That's maybe my biggest picture there is. But certainly a year and a half down the line, we'd love to just take collateral out of the payment system. That would be a huge win. That'll be $300 billion being injected back into the real economy, businesses investing that into the staff, into technologies, into capabilities, into new supplier relationships so that they can grow. I think that would be a huge win in the next sort of 1 to 2 years. But really the long term, how do we basically let businesses work with other businesses quicker, faster, easier?
Well, I hope you guys succeed because that's the fundamental state that humans want to be in. It's how we built our society is a trusting, trust first cooperative environment. And when doing business, you have to take so many counterintuitive steps to kind of protect the business that it introduces, not just obviously this is a business problem, but it also introduces a human problem in that it's much harder to trade person to person across borders, which we all want to do now, than it is to just trade domestically, and that probably doesn't do our global harmony any favors. So I hope you guys succeed, and thank you so much for sharing your thoughts today. And I hope to be seeing you guys out there making headlines soon.
Thanks, Jonathan. Yeah, we're very excited, and thank you again for this opportunity. Very happy to get this chance to just share what we're doing.
Thanks, Rajiv. Have a great day.
All right. Have a good one. Bye.
Bye.